started, we kind of first want to go and just mention the respect of just the human element here. And the fact that we're certainly not trying to be science or medical experts, and if we were, we would do a very poor job at that. So please remember that we're just simply trying to lay out the information as we see it, and most importantly, really lay this out in a way that affects, the financial planning environment and specifically our clients. So, always keep that in mind as we're kind of.
What happened?
I want to remind everybody, we're going to try to get to everybody's questions. If you do have questions, since we have so many people on the call, it doesn't make sense to have everybody's audio on. So do send those questions to the email address at the bottom right hand of the screen, Ali and Steve at hgwscolorado.com, and we can go ahead and try to get to as many of those questions as we can at the end, but we'll certainly respond to you by the end of the day with your questions.
Okay, so, kind of first looking at the couple topics that we're going to cover today. So first we have the current market reaction, obviously kind of looking at what has happened over the past week, really. Then we're going to look at comparing previous virus events. I know a lot of you saw our email that kind of looked at that, so we're going to dive into that a little bit more. Look at the current status of the coronavirus event, and then also, again, most importantly, looking at the financial planning and really investment side of what's happening and, kind of what we all should be looking at, considering, and that type of thing moving forward.
That's right. So getting on to the market reaction, I don't think we need to tell you that there has been one. Just last Thursday, we set an all-time high in the stock market. Everything seemed like it was going well. And then, of course, the coronavirus economic issues started to happen. So now we are down through yesterday, 11.63% on the S&P 500. The top line that you can see there, those are bonds. The bond aggregate index, relatively flat, positive 0.62%. I can assure you that while there was a lot of economic forecast at the end of the last year, beginning of this year, none of them had coronavirus included. That being said, there are often unknown issues, and this is certainly one of them.
Yeah, exactly. And I think really the thing that we're concerned about too is, really looking at the economic slowdown that this could create. And I think to be realistic, probably likely will create as we move forward. I mean, anytime that, you shut down entire economies and don't let people go outside, you're certainly going to see, a pushback from a consumption standpoint and how to look at that. But the way I kind of look at it is, if I live in Italy today and tomorrow I was going to go buy a car, right? So obviously tomorrow I'm not going to go buy a car now. But does that mean that I don't need a car? And I think the answer to that obviously is no. I still need a car. My consumption and my spending is still going to happen. It's just going to be a little bit altered.
Correct.
So I'm not going to have that happen in Q1 or maybe even Q2, which is going to affect car sales and GDP and kind of consumption as a whole. However, will that be made up for at the latter part of the year?
That's right.
And we think that it will. So that's kind of the way that we're looking at it and, kind of looking at, okay, why is the market reacting the way that it is? Likely looking at just kind of a global overall, slight slowdown. So I guess when we look at this in comparison to other events that we've seen, kind of starting with SARS all the way up through Zika, this is what we've looked at. Now, historically, these virus events really have not been severe as far as market declines go. That being said, with this coming at the top of a market record, I mean, we set market highs last week. We think that there's probably a combination of things happening here. Probably some people taking some profits, which just means, selling some of their investments that, they kind of were thinking coming into the beginning of the year. We came off a good year. We needed to take some profits anyway. But, kind of looking at it in combination with, obviously the current threat that we have with the global slowdown as well.
Right, and the market has to price in the reality that there already is and will be those economic disruptions like Ali talked about. Well, we certainly don't know when this will end, and we don't know what's going to clear out. We're certainly confident there will be clarity at some point, but before then, we certainly do anticipate continued volatility, and we would think that this issue will probably look like similar to those in the past. So, looking at the current status of coronavirus today, you've got about 95% of the cases worldwide are still originating in mainland China. Other countries make up about 5% of those. There's been 4,200 cases outside of China. 700 of those were on the Diamond Princess cruise ship docked in Japan. I think that's an interesting anecdote.
And, looking over the past week, there is a little bit of good news. As it looks like the reported cases have dropped by about 21%, kind of looking at the high that we saw on February 17th.
Right, so 21% drop, and that's supported by the report of daily new cases, which actually is a drop to the lowest in the last month as well, with daily new cases of at or below 1,000 for the last week, compared to the numbers early part of February, which were closer to 3,000 to 4,000 per day of new cases. So where we certainly have not reached containment, and you are going to see this spread into more countries and to more continents, there is progress being made, and hopefully the news continues to get better.
Yeah, and I think, like we mentioned before too, that it's important to note that kind of the lingering productivity decreases is really the market's concern. I would say overridingly the market's concern, at this point. I mean, for example, the country of Japan canceled school for a month, and there's even been, kind of rumors and talks of the Olympics in Tokyo and, kind of what's going to happen there. But really what we look at though is the things that are happening and a slowdown in productivity, does that change, kind of the financial and economic landscape for our clients and what we're trying to do?
Right, so let's talk about the implications on financial planning and investments. I think it's very natural for people to ask, Allie, what do we do when something bad happens in the stock market? What do we do as financial advisors for our clients?
Right, we get that a lot.
Right, and the idea being that when something bad happens, we should move quickly to get out of the way of trouble. Now, through goal planning and the creation of the personal investment policy, we end up with that proper diversification for you, which is essentially how you deal with the unknown market risk before they happen, not during the event itself.
Yeah, because, kind of looking at that now, this isn't really the time to, make drastic changes to, like Steve said, to kind of get out of the way. And really the diversification that everyone in their portfolio owns does allow you to reduce that downside volatility. And also to allow to have, kind of liquidity for cash needs and to also have funds that are available for different market opportunities that, that can present themselves. Because I think a lot of times, especially for retirees who are receiving income, I think that people can look at this and say, oh no, now I can't take my income, which, we'll kind of explore on why that really isn't the case. And yeah.
Right, yeah, and long and the short is we just don't put all the eggs in one basket. Right, so when stock markets generally are the thing that drive returns over time, it's also the thing that drives sleepless nights over time. And we need to make sure that we don't have all of our clients' money invested in stocks all the time through the good times and through the rough times.
Yeah, and I guess let's kind of take a look real quick at that diversification that we have across portfolios. So this is through yesterday. And basically what we're looking at is S&P 500 is your blue line, and what we consider is a diversified portfolio, about a 60% stock, 40% bond portfolio. S&P down close to 12, that portfolio down, a little less than 7. So you can see that certainly not taking on the full volatility of the overall market, and still kind of allowing us to maintain balances and kind of pieces of that pie that's not only going to be flat, but actually slightly positive through kind of environments like this.
Right, and what I think is interesting is going from a market high last Thursday to where we are now is actually the quickest drop to a 10% correction since World War II, and that's a unique environment to see how a portfolio can play out, and to see that diversified portfolio, a lot of our clients have portfolios like this, was able to mitigate 40% of the risk over that 5-6 really crazy trading days is great news. Mm-hmm. It's reaffirming for me for sure.
Yeah, absolutely, and I think as you kind of look through here, it's important to look back and take a look at how has this happened into previous kind of virus events that we've had. So this is looking at Zika. So I'm sure a lot of people remember, Zika took place in late 2015, early 2016. And being diversified before a market correction, allows our clients to benefit from opportunities that are there. So just to let you know kind of how we're dealing with this type of environment is, I'm sure a lot of people have seen over the last couple days, we have been repositioning portfolios, trying to, actually sell some of the bonds or cash things that were a little bit safer have held up pretty well over these past couple days, and purchasing stocks. And that was something that we also did, through the Zika virus emergency that we had as well. And I know that during market corrections, it doesn't necessarily, feel like a great opportunity. However, when you look back and you think about where we've come from, with the exception of this last week, it has always been the right decision. And the reason I say that is because markets were at all-time highs, which means if you had bought at any moment prior to, it was a good time, to invest. Because I know that this stuff can feel pretty bad, and the problem too is that we don't see the other side of this graph. So, we're looking right now at kind of the depths of the pullback of the coronavirus, and we don't see the other upward sloping line. But, kind of using history as a guide, we certainly try to take advantage of, really steep, deep, quick pullbacks, and that's what we're seeing right now.
Right. Let's do look closer. Let's compare this to let's look at the Zika virus up close. So this was late 2015, early 2016, talking about the Zika virus. The S&P 500 dropped by 12.9%. That correction lasted 66 days until the end of the Zika virus event. From the end of that event to today, the S&P 500 is up 76%. So if you can see in that chart there at the depths, that is an opportunity to basically take some of the money from the orange line, which is your bond index, and invest that money in the blue line, which is the stock index. And if you do that over time, if you make those decisions consistently and through a process, you're able to benefit. Allie, do you want to talk about that process a little bit?
Yeah, so similar to, what I was talking about before is just, trying to, keep a level head when these types of environments happen. Now, as you all know, who've been working with us for a long time, we certainly don't pretend to know when the bottom is or how we can do that. But so we create basically a process that when certain things happen, for example, the overall indexes pull back, 10%, we see that as a buying opportunity. Now, by no stretch do we, jump in head first and, move everything from bonds to stocks. However, by doing little bits at a time, we think that you're able to take advantage of a decline that we don't think is going to be, something that's going to last, really, forever, right? I mean, we think that this is presenting itself as a good position, and by using a process in order to do that, we're confident that we can take advantage of moves like this. And if we continue to move lower, which is absolutely a possibility, we will continue to do that. So we will continue to try to take advantage of moves that present themselves and position, you guys and our clients to be able to take advantage of that, and then also pull that back off once we get to, kind of a little bit more stable ground.
Right. February proved to be a kind of a unique month in that early part of February, we actually initiated a rebalance in the portfolios where we took some money out of stocks. Early part of February, reinvested that in the more safe, less volatile parts of the portfolio. Just this week, because of this correction in our clients' portfolios, we've begun the process to initiate rebalance where we were now purchasing stocks again after they had dropped. We all know you're supposed to buy low and sell high. Emotionally, that's a hard thing to do. Using our discipline process, we've been able to do that.
Yeah, and I think that this next chart really speaks to how difficult it is to do that. Because I think that, we can all agree that buying low and selling high is absolutely the thing to do. However, when the rubber really hits the road and we get in these environments, these moments that we're in right now, it's very difficult to do that. And it's not just for, us. I mean, you can see basically the chart that you're looking at is looking at the S&P 500 total return versus the average equity investor return. So we're not talking about a diversified portfolio. We're talking about investors that buy stocks.
Right.
Okay. And you can see these dramatic difference, especially look at that 30-year, the dramatic difference between an annual S&P 500 return and an investor return. And this happens in these moments because what happens is it gets emotional. It feels like this is just the beginning. We're going to be on a downward slide forever, or for at least the foreseeable future. I want out of the way. It's been painful. My investments are going down. My hard-earned money is less than it was a week ago. Now, all of those things are true and completely agree that it can be a concerning point in time. However, sticking to your plan and putting together a plan that makes sense for you when we're not in these environments is incredibly important so that this type of chart doesn't happen. because what happens is investors get overextended in positive markets. People want to buy stocks in late December, early January because the market was up, 25, 30%. But then we have moments like this and people kind of hop off the train. And I know, and this is really silly, but this is like one of my favorite analogies to look at, and I know I say it all the time, Steve, but one of my favorite ways to look at stock investing is it's very similar to a roller coaster, is that roller coasters are incredibly safe so long as you don't hop off and on in the middle. It's the same thing with stock investing too. It's incredibly safe over time. You do make money. Look at these charts. Absolutely, over especially prolonged periods of time, you will make money just so long as you don't hop off in between, because then it's incredibly dangerous.
Right, absolutely. It's important to have a plan. It's mostly important to stick to the plan. Know that that's easier said than done. So, as we wrap up here, over the last 17 years, we have seen 6 virus emergencies. They're all very sad, very human events. They have a very real human toll. And the market reactions have been varied in both depth and length, for sure.
Yeah, and we do really want to, stress that, of course, we have no idea how this is going to play out over the long term. And, it being nerve-wracking, I think, is probably an understatement. And, while none of us know, kind of what's coming, I think that we're confident that we are prepared, to take a look and to focus on people's goals and the financial planning that we've done leading up to this. Everyone has done the work in order to be able to weather this storm. Did we know the coronavirus was coming? Of course not. But to be fair, did we know volatility was coming? Of course. Everyone knows that a part of stock investing is the extreme amount of volatility that you have to deal with as an investor in order to be able to meet those goals. And we are incredibly intentioned and purposeful in creating portfolios that are not only going to, kind of weather this storm, but get you to a place where you can continue to meet those goals and continue to do what you're trying to do and not have to make drastic changes, to plans, to portfolios in the depths of these types of movements.
Right. So we're going to answer a couple questions. We really want to respect your time. We want to make these efficient opportunities to share information. We will be responding to all questions via email as well. If you do have any of those questions, again, the email address at the bottom right of your screen, Ali and Steve at hgwscolorado.com is where you send those. One question we got, Ali, is we haven't seen volatility like this before. Why is this time so different? I can assure you that every event feels extreme in the moment. However, market volatility is not unique. Since World War II, we've averaged about 3-5% corrections per year, about 1-10% correction per year, and on average, every other year we see a 20% correction. To give you an idea, we're at about 12% now. Volatility is a very normal part of the market. For sure.
Yeah, exactly. So feel free to, kind of submit those questions as you have them to that email address or online here. And here actually, okay, here's another one. This one's pretty common actually. How long do you think it will take the stock market to recover? Great question. Certainly wish I, knew an absolute answer to that. I think the best way to look at that though is to look at history as a guide. In the short term, it's very difficult to predict, when the positive outcomes are going to be here. I mean, on any given day, kind of day to day, it's about a 54% chance that stocks are going to be positive. So you look at that and you say, okay, well, day to day, it's about 50-50. But if you actually, expand that out and you look over, a 10-year period, all of a sudden, over 90% of days are positive. And if you look over a 1-year period, and I know I did that out of order, but if you look over a 1-year period, you're looking at about 78% of times market is positive. So over the really short term, I think it's really difficult to answer that question. But I think over the long term, we certainly feel confident that we are going to move on from this. We are going to go on to set, new highs. Unpredictable and uncertainty is alive and well, and we certainly acknowledge that. But our question becomes, does this event, or really any of the events that we've seen leading up to today, do these events warrant a substantial change in investment portfolios or how you're addressing the markets or how you're living, kind of what those financial goals? And we just don't think so. We don't think that this is a time where a dramatic change needs to be made. We're going to take advantage of the opportunities. We're going to buy stocks when we can, because we think that overall you're going to benefit from that. But we just do not think that this warrants a a substantial change to what, you guys as our clients are trying to do. I think we've prepared for this beforehand, and all of you are long-term investors and you know how this works, and this is just another thing that we have to deal with.
Yeah, preparation and planning is always the right strategy. I can assure you chaos and panic is never a good strategy. And again, every other event we've ever faced, I think the most common thing that Allie and I have heard over a decade and a half doing this, the most common fallacy I think we've heard is the comment that this time is different. 100% of corrections before in the past have reconciled themselves. Unless you believe something is, or have some reason why this is completely different than the past, it's really hard to go against a team that has won 100% of the time.
Yeah, exactly. And just not letting emotions pervade, I think, is really the name of the game. But it always has been. I mean, I don't think this is new for anybody who's kind of listening in here either. So, in the respect of time, we definitely are going to wrap up there. But please, let us know. I hope this was helpful. We're trying to, kind of get out and talk to as many people as possible in the most efficient way. We think this was it. Definitely give us your feedback. Let us know what you thought. And also let us know what other questions you have. Regardless of how we feel about, we think this is going to, go on to be better. We think these are opportunities to buy. At the end of the day, it's also nerve-wracking. Please let us know, what questions you personally have on your personal plan, or, how we can kind of talk directly to you to, address what you're trying to do. So, again, thank you all for joining us, and have a wonderful weekend. It'll be nice for stocks not to trade for a couple days.
Yes, have a great weekend.